So very good morning to you all. Last week, when we started this course, we had very basic, very rooted discussion about the revenue and the cost and the profit. Today, I want to discuss a little bit more about this concept of profit and the types of profits that we can have. Please remember that the profit is one of the core objectives of the corporates. It's a performance measure. If you start looking at the global corporatization, there was a time in the early 20th century when the modern day corporates were getting more established. Places like Houston, the places like Detroit were known for the oil industry and the automobile industry, and things were really going fast. The companies which were very small, they were becoming big. Hitherto, before this 1920-25 thing, there was no real difference between the ownership and control. Ownership means you are the investor, and control means you run the show. So technically, there was hardly any difference between the owners and the managers of the company. But because the sheer scale of the company became so much, because the companies were becoming so big, that to support the company's growth, the owner's own money was not enough. You see my point? If you are running a company, even though a startup, a small organization, and you find that there is a massive amount of growth opportunities, I mean, you can rule the world, basically. You have so many opportunities. And then to meet those opportunities, you need the financial resources. And then you see your pocket, it's not so full. And then what you do? You bring the external capital, the outsider's money. The outsider's money can be either when you borrow, but the problem is that when you borrow money, the lenders would press you to return the money at some stage. Or you sell your idea to the outsiders, they like it, and then they become your shareholders or partners in crime, basically. So that was a time when the private companies in America, in the USA, they were becoming public companies. Public means their finance was coming from the public at large. Not necessarily the founders of the company, but the public at large. And that shares were trading. So for example, today I take money from you, you stay with the company, you make money, and then you realize that it's time to bid goodbye to the company. You sell your shares in the stock exchange, somebody comes and become on board, stay with me, stay with my company, and afterward it keeps moving, basically. So that share become, it become tradable commodity in the stock exchanges. The one reason why I can woo my shareholders, why I can really attract to my company is that I should perform better. I give a good, astounding performance that they stay with me, either they buy shares and stick with me, or those people are thinking to buy my shares, they should give up all other options and come and join my company. So they want to see that how company has been performing historically. So what they would do, they would check some of the performance indicators of the company in question, okay? And one of the most strategic component of performance is profitability of the company. So profits are very important, yeah? So profits and profits. So profitability is very, very important. You see my point? This is why it is very important that we start this concept of profit in the discussion in the very onset, but we can't discuss profit unless we know the revenue and the cost, because very simple, high school arithmetic, what is profit? Revenue minus cost. So before we go into a deep down discussion of profit and profitability, it was essential that I give you some glimpses of revenue and cost. And this is why we spent a long time in the previous week. So now you know that what is profit? Profit is equal to total revenue minus total cost. Make sense? But now, today, as I said, as you can see, I have a Word file, and I will make you check the profit or profitability of these companies by yourself. But before I reach this stage, I quickly want to discuss the different categories of profit. Now, what happened is that, and at any point of time, if you have any questions or doubts, please raise your hand. We can have this whiteboard, and I can choose text. Imagine you are a company and you are manufacturing furniture. And let's say that you are making chairs. So at the end of the year, what you will do, you have sold, let's say 1,000 chairs. And the price of each chair has been, let's say 200 euros, for example. Whatever, unit, dollar, euros, whatever. So this makes it 2 and 3 more zeros. So 1, 2, 3. So does it make 20, 200, 2,000? So it makes 200,000 euros. What would you call it? Revenue. So let's call it total revenue. And for the sake of abbreviation, I can call it as TR. And then we have the total cost. The cost is very interesting. If you are manufacturing chairs, you should have first, let's go in the order, right? Your first cost would be production cost. When you want to make some chairs, what do you think would be your production cost? Just visualize factory type of settings. Furniture is being manufactured. You need people, the manpower. You need the carpenters. You need the factory workers. You need the engineers, designers. So that manpower, okay? Let's say that the manpower or the labor charges or the labor expenses are 30,000, okay? What else could be, what else could be what else you think? Am I recording it? Oh yeah, I'm recording it. Raw material, excellent. So the next production cost would be raw material. Anything else comes to your mind? Let's put some number. Let's put some number. Let's say 10,000. Oh no, let's say 20,000. Which taxes? An example? Okay, some of the taxes on when you buy wood, perhaps because when you buy the wood, it means that you cut the forest. So there is some levy or there's some taxes, like as you said, ecology tax or any environmental tax, right? And they're directly concerned with the production, okay? Yeah, they might be even included in the, you're very right. It could be that these raw material when you buy, like for example, when you fly these days, you have the air ticket, but you also have those tax, pollution tax, and that all comes in the ticket price. You're not having two different tickets. That is inclusive. Yeah, that's so we can assume that all the taxes thing which you talk about are already included in the price of raw material. No, production. But you're right. When you bring the wood in, the inward transport, that is a cost, that's a production cost. Because unless the truck, the lorry, the haulage bring the wood in the factory, you can never do manufacturing. So you're very right. I can call it inward transport. And let's call it, say.
But that can also be classified under logistics.
Sorry, can you speak louder?
It can also be classified under logistics.
Logistics, right?
Yes.
Okay. So anyways, you can give me many examples of production cost. Let's assume that altogether, but is anybody else have some point which you want to say? Yeah. Sorry? Rent. Yes. Because after all, factory is a place, and rent nowadays is massive. Rent and anything else? You have some?
No, exactly. Of course, they need machineries. And
rent, let's say, is 1,000 or 10,000, whatever. And something else you said, you guys.
It was, I said, machineries and maybe the electricity. I don't know if we're.
Yeah, depreciation, sorry, electricity, the energy, okay. But I don't want to go each and everything, right? Some items we know that they are. So in general, let's say. And depreciation is something which I want to focus on. Have you heard the phrase depreciation before? Huh? Depreciation. Look, depreciation is something I can write down. And since it's a good time to explain it, depreciation. And I will also use at the same time this phrase amortization. It's very important that you get this vocabulary rich. Depreciation and amortization. And let's say that this is about, I don't know how much, but this much. Depreciation is whenever you buy some fixed asset, the fixed asset generally has a fixed life. We cannot really forecast that how long the car would remain alive. We don't know. But as in business sciences, we are using estimates. So we can make some estimate about the working life of an asset until which you can get the benefit from it, okay? So let's say you buy a car for 30,000 euros, and let's say that it's a business car. You are using it for your business purposes or a lorry or whatever. And let's say that we make an estimate that working life of the car would be 10 years. So basically it means that 30,000 is the value divided by 10 years. It means that each year you are consuming the value or the worth of car equal to 3,000. So for example, you buy a brand new car and you estimate the depreciation, this usage of car for 1 year. Look, the car you buy today, brand new, working life 10 years, you spend 30,000 and you use this car for 3,000 for 1 year, 3,000, divide by, and then if you want to sell this car in the beginning of the second year, then the book value of the car, book value, I'm not talking about the market value, the value in the records, the value in the accounting books will no longer be 30,000. It will be 3,000 less because you have taken the services of the car equal to 3,000 euros in 1 year. Assuming that the working life of the car is 10 years. Now in your books, The book value of the car is 27,000. And each year, this value will decline by 3,000, 3,000, 3,000. Now, by the end of 10th year, you may be still utilizing the car. You still may be running the car and it's going very well because you got fantastic handling. You are maintaining it so well. But in the books, the value of the car would be 0. So the car would have 0 value in the books, even though if you want to sell it to somebody you might find who's offering you 4,000 euros in the second-hand car market. But that is a market value, not the book value. You see my point? So each year, this erosion of value of the fixed asset, this phrase is denoted by depreciation. Depreciation is the fall in the value of the fixed assets because of the usage over time period. Does it make sense? This chair might have a value. This marker, this computer might have some value. The computer you buy, laptop, 3 years maybe. Like for example, in our organization, we have a rule that after 3 years, the staff computers are changed. It means that inherently, implicitly, people over here, accountants, controllers, they assume that the working life of the laptop is 3 years. So if this laptop I'm using is for 1,000 euros, let's say 1,200, then the depreciation is 400, 400, 400. Look, I'm still using, interesting example, this laptop right now, which I'm using, I have been using for over 3 years. I've got a new laptop. I haven't started using it, but this is 2 months over 3 years. The book value of this laptop is 0. But if just it happened that but it still has some value, market value. So if I want to sell this laptop, I will not sell it for free. This has some, and that price would be called the market value, even though the book value is 0 now after 3 years. Does it make sense? This is called depreciation. Depreciation is the decline in the value of the fixed. Remember one thing, never forget, this is calculated, this concept of depreciation is applicable on the fixed asset only. Fixed assets, the one which has a physical property, I can see it, I can touch it, it has a weight, it has a volume, so on, so forth. You can see it with the naked eye, you can touch it. So the fixed assets. Make sense? The second phrase is very interesting. It's called amortization. Amortization is exactly what depreciation is, but the only difference is that amortization is applicable on intangible assets. Intangible assets. You develop some software, it will not remain eternal. It will go, the value will go down. You have some copyrights, the copyrights will never be with you forever. At some stage, your copyrights will be over. You develop some, what is the phrase? Patents. Let's say GlaxoSmithKline, the famous pharmaceutical company, they develop some drug and the drug patents are applicable for 10 years. For 10 years, anyone who is manufacturing GlaxoSmithKline has to pay a royalty to GlaxoSmithKline. But after 20 years, that drug will go off patent. Now anyone can make it. Now patents, they look like a machine? Do they look like a building? No, it's just based on your intellectual property. It's a non-physical, intangible asset of the company. And when there is a decline in the value of intangible assets over the time period because you're using it, right? Look, when the GlaxoSmithKline develop a new drug, it will be popular, but over time, maybe the bacteria would be so strong, or maybe over time things will go well, or maybe the other drugs will be there in the market that its value will go down. The drug which was very active on the patient in the first year may not be so active in the 10th year. So this reduction in the value is called amortization. So rule of thumb, depreciation is decline in the value of tangible assets, and amortization is the decline in the book value of the intangible assets. Remember, book value. No, I'm not talking about the market value. Look at the example. I gave the example of the car, right? The car you bought 10 years, the value is going down, 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 eventually zero, right? But have you seen sometime people still keep that car, and after 30 years, 40 years, that car becomes an antique. And then people are paying a big money. Hey, this is the car manufactured by Ford in 1920, right? So somebody bought Ford model, whatever, in 1920. In 1930, the car's book value is zero. But maybe in 2020, there's a queue of people, auctioneers, those people who maintain those antiques. They would pay you maybe, I don't know how much money, but that is a different thing. So the market value still there, book value over. And market value keep changing. Maybe in 1931, nobody was willing to buy that car, but now in 2023, there are people, auctioneers, in the very famous auctioneers and those people who maintain those old stuff. They are collectors, yeah. They can pay you maybe 1 million for that car. So the book value is still zero. The book value became zero of this car in 1930, but the market value can keep fluctuating over time. So therefore, the concept of depreciation and amortization is very important. This young building premises, this infrastructure had two broad categories. One is the piece of land, and the other is a superstructure. You see my point? There's a land, horizontal, and then there is a building, vertical. The superstructure, the building, can depreciate over time. But on the other hand, you can't say the same thing for the land. Land is scarce, people are coming, there's more demand for land, supply is less, the price goes up. Then the opposite of depreciation is called appreciation. So some assets over time, they appreciate. But some assets over time, they depreciate. So therefore, appreciation, and I can write this word, even though it's not applicable in this example. Appreciation, increase in the value over time of an asset. This example of this Ford 1920 sold, 1930, it was depreciated to zero, right? But in 2023, somebody is willing to pay 1 million euros for it. Now this is called appreciation. Yeah, so therefore it's very interesting, very important that you are, time value is very important in finance, in accounting. So it's very important to see the concept in the light of time period, whether the value is increasing or decreasing over time period. If it is decreasing, it's depreciation. If it is increasing, it's appreciation. Any questions? Anything to contribute? Yeah, go ahead. Yeah.
That of the license. If 5 years, so we can amortize it during the file.
Yes.
And one more question related to appreciation. Appreciation, I think in my own country, I bought like a car 5 years ago, and based on the accounting rule, it should be like decreasing the value, but based on things like inflation, it's going to be more upper in the cost. So appreciation have to kind of.
When we calculate the book value, we discount for the inflation, because otherwise comparison is never possible. So we have to keep the fixed price. We keep the inflation impact out. Otherwise, comparison becomes, otherwise everything has appreciated. Just imagine you buy something, let's say our grandparents buy something in 1949, something. Definitely that thing is more pricey in 2023. You see my point? But the question is that then people were having less money, less income, less wealth, but now people are having, more salaries. So the value of the money is not same as what it used to be. So when we make these comparisons, we have to, keep into mind the inflation as well. Like, for example, let's say, let me, this is a sidetrack example, but I can give you. Imagine you're earning 2,000 euros in 2020. This year, your salary is 2,500. So there is a 25% jump in your salary. How much? 25%. But imagine in this 1 year, the inflation has increased by 50%. I hope it never happens. Then basically your money, your monetary income, 2,500 in terms of number is more. But the purchasing power of the money has gone down substantially. So actually, despite having more money in your wallet, you are worse off than before. You have become poorer over time. So that is why we keep into account this inflation impact as well, right? All right, so we have depreciation, we have amortization, and let's say we have some more examples also. So much so that our total cost is equal to, let's say, 130,000. Okay, but this is called, I shouldn't call it total cost, I should call it total production cost. How much is that? Remember, all these things are directly concerned with the production. Now tell me something, your furniture is now manufactured. What next? The factory, your furniture is lying in the factory. Do you expect people come to buy furniture from you from the factory? What would you do now? Now, you have to do something extra. You have to spend some more money. And that could be called as selling and distribution expenses. So that the furniture is not in the factory. Now it's available in Prisma, in IKEA, or in other stores. You go there, you don't have to go some factory near Lahti or somewhere else. Just go to the store. Imagine there's only one factory making furniture, maybe two factories in Finland, and everybody, all sides of Finland, they drive to these places and buy. That will be very difficult. So now what happened? Now it goes to the retail outlets where consumers can go. You can have more than one retail outlets in the same city, even though all the furniture is manufactured in the two factories in Finland. So now it happens that you have to, the good is ready, but now you have to reach the customer so that the customer can go and see the items on the shelf or in the showroom. So those expenses which are incurred, and these are very important expenses, they are as important as the manufacturing cost, the production cost. And these are called selling and distribution expenses. And let's say that these are 20,000. Now, your total cost of goods sold is how much? The cost of goods sold includes the production cost and other vital overheads. And by the way, coming back to this point, when you said that transportation expenses, now the transport outward, that you're loading the chairs from the factory, and now they are going to the retail outlet. So now this also includes this outward transportation expenses as well. So anything which helps to send the goods away from the factory to the shop where the consumers can buy, right? So this makes cost of goods sold equal to 150,000, okay? And now, you know your revenue, you know your cost. Does it make sense? Now the difference between 200,000 and 150,000 will be called what? Your revenue is how much? 200,000. Your cost is how much? The difference is 50,000. So you call it, don't call it profit, call it operating profit. Why? Because it comes from the company's core operations. You see my point? This comes from the company's, this manufacturing company of furniture, they're selling chairs. Look, they are not working as a property consultant. I'm not saying that this company might have some free building somewhere, you know, the vacant building, and then they give this building, a building on rent to somebody. Will they get money from that? They will. Am I counting it in this calculation? No, because that is not the operating expense. Getting the rental income is the operating income of a property company, not the furniture company. You see my point? Similarly, this company would be having a bank account as well. When you have the bank account, what do you get from the bank? Interest. Is interest the operating income of a furniture company? It's a non-operating income. Similarly, this company would be, let's say, let me find some example. You get the idea, right? So we are only talking about the operating income. Getting the rental income can be the operating income of a property company, like Quas, for example. If the Quas is getting rent, it's the operating income because that's their main business, their main job. But if there is a engineering goods making company and they are renting out some building because they're not using it, then this is not their operating income. It's a non-operating income because that is not the core business. Why you like Apple iPhone? Because that is their main operation. But Apple would be having the bank account as well. Apple would be having the rent from some buildings as well. But we don't care about that income. What we care about is that how much Apple is doing in the, how much Apple's profit is increasing because of its operating income, not because of the rental income or the bank account they have, whatever. By the way, this company might be having some investment in some other companies also. And what do they get when you invest shares in the other companies? What do you get? The share of profits of those companies, dividends. So here, this company may be sharing the profit of the other companies. But in this profit, we don't care about this because this is not the main operation. The company's main operation in this case is that sell chairs, sell furniture, that's your job. We can make some little bit of compromises. We're not very Puritan, we're not very strict. We can make some compromises. For example, a company Y approaches this X company and they say that, you know what, you guys are doing fantastic in furniture making. I'm planning to open a same manufacturing company in Estonia. And believe me, I will not compete you. You know, we keep aside, but I need your help. If you only provide me consultancy, if you become my consultant, if you send your engineers, if you send your designers, and they help me in making chairs in Estonia, I'll pay you some reward. This consultancy services would still be added as your operating income because it is again come from something related to the company's operations. So there can be some flexibilities while calculating operating income. All right? Make sense? Any question about the operating income? Operating profit is something which come from the company's core operations and things, right? A little bit of variation. Operating income, with some exceptions, can also be called as gross operating profit. Gross is not always a bad word. And net operating profit. The gross, people who give this formula of gross operating profit, they say that the gross operating profit could be this. Have you heard this before? EBITDA, which means earnings, or we can also call it PBITDA, or even sometime I have seen, which is theoretically wrong, but accountants don't care about theory. They're practitioners. They just use the phrase without knowing the context. But academically, it's wrong, but I'm still using it because when you have a real case company, then you have to believe what accountants are saying, right? Then you will not say that, hey, because my teacher said it's wrong, so I will not take this calculation. This could be even EBITDA. Only the first letter is varying, right? E, P, and I, right? E for earnings, P for profit, I for income. Conceptually, earnings, profits, and income are not same. But as I said, that sometimes accountants don't even care about these things. They just go with the tradition. If they have been using the word income instead of profit for the last 20 years, they keep using the same phrase again and again. Because their books are checked by the auditor, not by professors. So that is why they can even use some of the wrong phraseology. But as long as we understand what they're trying to say is fine. The thing is, the earnings before interest, tax, depreciation, and amortization. So if you are calculating operating profit, which still not subtracting depreciation and amortization, then this is called earnings before interest, tax, depreciation, and amortization. Or you can start the phrase with the profit before this, or income before interest, tax, and this. But basically, you are referring to gross operating profit. So some people say that don't subtract depreciation and amortization from that. But I don't like it. I think this is a better formula. This is nothing but the same, but the only thing is that it becomes EBIT, PBIT, or IBIT, which means that this takes away what? Depreciation and amortization. So if you see the calculation that we have done here, you know, this operating profit. So please tell me, is this operating profit EBIT or EBITDA or EBIT? Is this operating profit EBITDA or EBIT? EBIT. So this is EBIT because we have subtracted. This is the earnings before interest, tax, and depreciation. We're not taking that. We have subtracted depreciation and amortization. So for example, if I don't subtract this amount, then our profit would have been 60,000. Am I right? Had I not subtracted this, can you see the cursor here? Yeah. Had I not subtracted this amount, then how much the profit would have been? Then you can call it EBITDA, or gross operating profit in simple words. But the fact is that we have subtracted it. Depreciation is a reality. Amortization is a reality. We subtract them. And then what we get is EBIT or PBIT or IBIT. In simple words, net operating profit. And I'm in favor of net operating profit because depreciation is reality. You can't deny it. How is it possible that you buy a fixed asset and you don't treat it periodically? So you have to keep into account the fact. It's all based on logic. If you don't subtract depreciation, basically you're saying that we bought a car in 2010 and nothing happens to its value until 2020. How is it possible? I mean, the car you buy from the showroom, inside the showroom, the moment the car comes out of the showroom, its value declines. For example, you take the car out of the showroom, brand new car, and then suddenly you change your mind and you ask the selling agent, hey, I don't want this car. Can I sell it back to you? He will say, okay, you can, but then we will give you less price because the car is out of the showroom. So fast the value goes down. So if we are calculating operating profit as EBITDA, then we are ignoring a very important reality that depreciation is not considered. But the depreciation is a reality. We use things, the value goes down. We often complain, oh, we bought this phone, but now I think the battery is not fully charged. I charged it only 1 hour ago and it's now gone down. You see, you start complaining, cribbing. That is a sign of depreciation. Maybe you don't notice it for some time, but eventually you start noticing that now it's time to change my phone, change my laptop. It's getting blurry, it doesn't work well. It takes ages before it downloads anything or saves anything. Right? Make sense? Okay. Right. So how much operating profit we have so far? So how much is a EBIT or PBIT or IBIT? Why I'm saying these words? See, there's a reason why I'm using so many words, so many synonyms, because it could be possible that the company which you pick up for analysis might be using some different phrases. So I want that you shouldn't be confused. So yeah. And in simple words, this whole thing is called net operating profit. And this we found on the previous page, it was 50,000. The next expense. See, the life is very expensive, right? So all the expenses are not over yet. We still have some more expenses to keep in mind. The next expense is called finance cost. Finance cost. And finance cost basically are your interest expenses. Interest expenses. What are the interest expenses? You borrowed money. Now it's time to pay the interest, not the principal, but time to pay the interest. You borrowed some 50,000 euros last year, and now the interest rate is 5%, imagine. So it means that you have to pay 2,500 a year to the bank. This is called interest expense or finance cost, okay? So let's say that this company, this manufacturer, this furniture making company, they also pay 2,000 euros as interest expense. Okay, now what do we have? We have one more category of profits now. This is called, what should we call it? We call it profit, PBT, EAT, EBT, oh my gosh, or IBT. profit before tax, because we haven't paid yet tax. Remember the phrase EBITDA. First, we took away D&A. It leaves with us EBIT. And now what we get rid of? I, interest. And what is left now? T. So this is profit before tax, or earnings before tax, or income before tax. I repeat, conceptually, profit, earnings, and income are not same things. But practitioners, the accountants, they don't sometimes distinguish between these technical, conceptual sophistications. They just, take them with one stroke. So how much is left with now with this? So it's 48,000, right? Is it end of the story? We still have something. We have tax to pay. Which tax? Not the tax you're talking in the beginning, that it's environmental or it's custom duty, not those type of tax. You remember at the end of the year, we file our income tax return. You know that? The companies at the end of the year, they also file their income tax return. And that tax is called just tax, but to be more precise, we call it corporate tax. And let's say the tax is 8,000 euros. Now this is the final profit with you. All right. So this is the profit which is now nobody else have any claim. And this profit is called, first it was PBT before. What comes after before? After. What comes after before? After. So I said the answer already. So now do we have PAT, EAT, or whatever it is? 40,000 euros. This is the profit after tax. This is the income after tax, or is it the earnings after tax? This is the final earnings of the profit of the company. This profit belongs to who? To the company's owners, shareholders. All right? So basically, this is the profit with the company, which can be distributed or given to the shareholders. But please tell me, do you understand this mechanism? That first of all, we have the operating profit. Then we have we take away the finance expenses, and then we have the profit before tax. And then finally we pay the tax, and then we have the profit after tax, which is the ultimate profit. And conceptually, we also call it residual profit. Residual basically means leftover. It could be possible that after paying all these stakeholders, nothing is left with the company and company has a loss. So it's not taken for granted that your profit after tax will always be positive. It could be negative. If it is negative, then it's a loss. What can we do? Business has risk. It's not like a salaried job. It's not like the fixed interest income. It's not like a fixed rental income. Because it comes from the enterprise, and by the dictionary meaning of enterprise is to take a risk. And risk can backfire. It could be loss as well. Make sense? So this is the profit which lies with the company. Please tell me, what company should do with this profit? Invest the whole money? Huh? Yeah.
Some part of their dividend, the owner or shareholder. But of course, there are some short amount you should reserve.
Very good, very good.
Situation. The percentage of that amount is published by the government. They are different.
Yeah, I think it's more like a company's choice also. There's no fixed regulation, the company may have choice. Yeah. 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 Okay. Good, good. Very good point. Dividends. After all, these people who are behind this whole show of this furniture making company, they have taken huge risk. And now it's time to reward them, give them the share of profits. And that share of profits, what they get is called dividends. Okay, so let's say the company decides to give them 20,000, right? So this money belongs to the shareholders, and the rest money is called reserves and surpluses. Like we do in the household, we get salary and we don't spend all the money. We make some savings. The companies do not give all the profits to the shareholders. They make also some savings. Why do we save money? We have exactly the same reason as a normal, ordinary, common household have. Good reason and a bad reason. The good reason is that in the future, the company's product will be more in demand. They want to expand their businesses. They want to open the branch somewhere in Stockholm as well, or in different cities of Finland. They also now want to make tables along with chairs. They also want to make some beds. You know, they want to diversify, not just chairs, but more items. They want to expand their business. So they need some money. Now, they can't just simply wake up and go to the bank and borrow. No, they should be having some accumulated saving over time. So if they're saving 20,000 each year, and by the end of 5th year, they have a saving of 100,000, they can easily make some strategic investment, which involves big amount of money spending. That's a good reason. The bad reason is that maybe in 2 years, 3 years time, the company there is a severe market crisis. The market is crashing almost. It's a very bad situation. Then they should be having enough money in their savings to spend and continue their operations. And so they can buy more time if they're financially resourceful. And if that also show the long-term vision of the company, that they don't believe in the present alone, they also believe in the future. So they save so that if there is any bad time striking them, certainly there is a bad situation in the market, they can handle that financial crisis more smoothly than those companies who believe in today and there's no future, you know? So this thing, there can be good reasons, there can be some bad reasons also. But this money saved is like saving. You can call it corporate saving if you want to say, but like a household saving. But I think more often we use the phrase reserves and surpluses. Make sense? Okay. We take 5 minutes break. You recap things. Welcome back after this short break. This is the income statement, and this is exactly the different categories of profits. It's not showing up? Okay, just a second. My apologies. Share screen. Yeah, now it's fine, yeah? Okay, so this is the income statement of a real company whose name is British Petroleum. Have you heard about it? Very famous British company, but it's also listed in New York Stock Exchange. That is why you can see that the currency unit here is dollar million. So all the figures are in million, for example, okay? So don't assume that they're having some $576 income from somewhere. It's $1 million, okay? 576 million. And if you look at the main revenue, it is $278,397 million. So this shows how big the company is. So it's like in billions rather. So the revenue is in billions, right? You can see here the block of figures starting here and ending here. Remember, each company would have different sources of income, but theoretically, it will be either operational income or non-operational income. The theory doesn't change, but the items of income can change. The kind of income BP has, Netflix would never have. Why? Because BP is an extremely tangible assets-based company, and Netflix is totally, you know, that intellectual property, basically. Similarly, the kind of income statement that BP has will not be same for Walmart, because BP has a huge B2B trading, the business-to-business trading. Whereas the Walmart is just like you go buy something, you go to till point, pay cash, take the delivery. So it's a very cash-based company. BP is not so cash-based. BP has two clients, two category of clients. The one who buy the gas at the gas station, they are like the cash and carry customers. You know, you never have gas until you pay. But then the gas is not the only thing which BP provides. It also provides many chemicals, very industrial chemicals, to the big multinational companies. And also different type of oil and oil mix. And those people don't pay you at the till point. It might take time before the money comes. So each company, their stream of revenue could be different, but one thing would remain certain, that the category of income or revenue rather, should say revenue, it would be, you know, talking. Emma,
mikä sun IG on? Ja tälleen, se oli ihan hämillään, koska mä kuulemma näytin.
You asked to mute, because otherwise it will come in recording as well. You can see here, BP has sales and other operating revenue. Then BP also has some earning from joint ventures. You see the joint venture, the second point, and then from associates and so on and so forth. I think I shouldn't say anything about the first sentence. It's so categorical. Main operations of BP, right? Make sense? Operating income, the pure operating income. And then BP has some joint ventures. What is a joint venture? What do you mean by a joint venture? The joint venture is, just imagine that there is a Malaysian oil exploration company. They enter an agreement with BP that because you guys have better technology, you have a lot of experience. And I think that if we have 50-50 or 60-40 ratio, and we open a new exploration unit in Malaysia, then we can work together, and 50-50 or 60-40, we can share the profit afterwards. The main thing is that both partners, or even more than one, two partners can be, the share is very much close to each other. It's not exactly 50-50, but 60-40 is quite, even if it is 40%, it's quite significant. You see my point? So when there are partners, almost equal partners, then this is called a joint venture. Okay? And then we have another category of cooperation between companies called business associates. The associate is that when the BP would be called an associate partner, if it is percentage is going down in terms of ownership, then it can be in the joint venture. Just imagine, there's a company from Kazakhstan and they approach BP. And they say that, guys, we have our own plant, everything is fine. We have our own engineers, stuff like that. We have our own, everything is fine. It's very, but you know what? We want your consultancy and we want that your engineer should come from time to time, visit us in our plant. If they see anything environmental problem to happen, they guide us and they help us to clear that affluence, so on and so forth. But you can be 30% owner of the company. Now, 20%, 30%, 10% is quite a low, percentage. In that case, it's an associate relationship. So depending upon the BP's level of ownership, BP can be called as a joint owner, joint venture, or it could be called as an associate. Even though it's not about accounting and finance, it's more about strategic management, but I can add more terms to you as well. It could be possible that BP is owning a full-fledged oil exploration capacity in Mexico. Only the land belongs to Mexico, but the factory, the manufacturing, the production, the exploration, everything is owned by BP. Then this will be called a wholly owned subsidiary of British Petroleum in Mexico. You might have heard this phrase, I don't know, but I can, if you want, I can type it. If, for example, BP is owning a company, all the production capacity, let's say in Mexico, then it's called wholly owned subsidiary. Or if the share of the home country or the home company is less, but the share of BP is more. Let's say BP owns 75% and Mexican company owns 25%, then this is called subsidiary, just subsidiary. So depending upon the level of collaboration and the level of cooperation, it can be at the low level associate, then nearly 50-50 joint venture, let's say 70, 78, 80% subsidiary, and 100% wholly owned subsidiary. Since what? Since BP has invested in these companies, be it associate or joint venture, the BP would be getting revenue from those companies as well. Isn't so? Yeah? Does it make sense? Should we call it as operating income, operating revenue, sorry. The money, the revenue which they get from the joint ventures and subsidiary or the associates, should we call it operating revenue or not? Do you think that they can be called for some other operations? Is it possible that BP is approached by Walmart that can you help us in starting a new retail business in Philippines or in Korea? Yeah. Most likely it will be the same operations. Very rarely it happens that you do something else. BP is an oil company. If it is going to be a joint venture or a subsidiary or associate, most likely it would be in the same set of activities. Okay, in one country, they are doing oil exploration. Maybe in another country, they have a joint venture about the oil distribution, but it's still oil. It's not they are distributing jewelry or ornaments or something else, but it will be still the main business, right? The function can change, but the substance doesn't change. You see what I'm trying to say? So joint venture, subsidiary, most likely they are in the same profession. I mean, I don't think that BP would be approached by HSBC. Hey, let's open a joint venture. I mean, what will they do together? They have different area of expertise. So therefore, I would say that the first three items, they fit or they befit to be termed as the operating revenue of British Petroleum. You may argue by giving the different arguments, but see what? If you want to see more details, that who are the subsidiary, who are the joint venture, who are the associates, there's a note 16 and 17, right? You see my point? In the financial statements of these companies, there are some explanatory notes given, which basically means that if you want to see more details, like a reference. So there is a reference. So for example, if I go to note 16, well, then I have to open the actual, I will do it later on, but Seher, please remind me. I will show them the explanatory notes as well, because this is a slide. I just took a, the screenshot. So that's why. So I don't want to, yeah. But I will explain it to you later. That's my promise. Interest and other income. It's a revenue of BP, but is it operating revenue? Interest and other income. There are some bank accounts of BP and they're getting interest on it. They're earning it. You think it's operating income? No, because this is not the core revenue, core business revenue, core operating revenue of British Petroleum. If BP was a bank, then this was an operating income. But now, because BP is not a bank, so it's just some non-operating income, non-operating revenue, right? And similarly, gain on the sale of the businesses and fixed asset. BP has some vehicles, some haulage, some, what is the word they use? The oil rigs, where they have those platforms, oil platforms in the sea, which they are nearly abandoned. They don't use them. And then some other company approached them and then say, guys, can you sell us? We'll pay you. And then the BP is selling those fixed assets at the second-hand, price. So basically, and it's called gain, right? Now, coming back to the gain, I want to give you the example. You bought a car. Remember in the very beginning, we discussed about the example. You bought a car in 2010 for 30,000 euros. The life of the car was 10 years. So at the end of 2020, the book value of the car is 0. But the car is in good condition and somebody is offering you 2,000 euros. Something whose value is 0 and the market value is 2,000. Good bargain or a bad bargain? Good bargain. So now what is the cost of the car? 0. And what is the price of the car? 3,000. If something has a cost 0 and you are selling it for 3,000, is it a gain or a loss? Gain, exactly. Same way. So BP has some fixed asset, including car, haulage. Haulage is something, the big trucks, which are used for transporting the oil, and they have oil rigs or whatever, even buildings, by the way. The book value is low, the market value is more, the BP is having a gain. But so money comes in, right? The money is coming in, but is it a operating revenue or non-operating revenue? Is BP a second-hand scrap dealing company? If it is, then it's an operating revenue. But since BP is doing, this is additional revenue coming to BP. So we call it non-operating revenue. So altogether, operating, non-operating revenue, if we club them all, sometimes accountants don't care, they just club it all. Then the total revenue, which BP earns is $282.6 billion in 2019. This is the old data, but of course we'll see the new data as well. I should have replaced with the new screenshot, but maybe I'm too lazy. So that makes it total revenue. Make sense? Yeah. Now, after we have the revenue, we need to subtract something. And what is that? The cost. The cost is the purchase. The purchase basically is referring to the main raw material which BP is using. Let's say BP is buying some billions of barrels of oil from some Saudi company. And this raw material which they buy will be called number one, purchase, and it's a cost. Which cost? Production cost, because it's a raw material. And then you can see that there is a series of taxes and so on and so forth. And then there's a depreciation, depletion, and amortization. Have we discussed depreciation before? Yeah, we discussed amortization also, but now we have a new word called depletion. Depletion is that if you look at the nature of the oil, if you extract 100 barrels of oil during the day, by the time the day is over, it will not be 100 barrels because oil can evaporate. That is called depletion, but it's a loss. But remember, if you choose Microsoft, or if you choose Walmart, maybe depletion will not be. Basically, depletion happens when you take something straight away from the nature. You know, like you are some farm, product, you produce some farm goods, or you take things, or you're a mining company, or you're an oil exploration company. If you take something straight away from nature, then it could be possible that you extract something, and by the time you are able to store it, save it, some things are lost. Yeah. Then there is some loss of assets. There are some exploration expenses. And then finally, it seems that from here until exploration expenses, these all are production expenses, the same category of, But finally, we have the distribution, selling, administrative expenses, and that is about 11,057 million dollars, sorry. And then now you can see that when all these costs put together from here to here, when all these costs clubbed, aggregated, are subtracted from 282,616 figure, we are left with the profit. And this profit is 11706. Technically, this is an operating profit, you can say, basically. Even though again, you have to be very careful. If you really want to calculate very pure operating profit, then in the revenue, you should not take this and this item. But as I said, that accountants sometimes they compromise the academic rigor, right? So this is what they calculate, which is the profit before interest and taxation. So it's PBIT. It means that out of EBIT, PBIT, whatever, what phrase is BP using? Profit before interest and tax, which is PBIT. And is this profit gross operating profit or net operating profit? It's a net operating profit because depreciation and amortization is subtracted from it. So this is you can say that even though, as I said, I don't fully agree. If I were the accountant of BP, then my operating profit would be lesser than this. You know why? Because then in the revenue, I will not add this and this item, because they come from some side track income. This is like a side income, side revenue, right? But since they clubbed it, okay, we can give some leeway. But as long as you understand, that's fine, right? Practice could be different from the theory. And we get the operating income. And then the next thing we need to subtract is called finance cost. The finance cost is basically the interest you pay to your bankers, to people who lend you money. You borrow a lot. The big companies borrow a lot, and you pay the interest. And then you pay interest. You also have some other expenses. And then what happens? The profit before taxation is 8154. And then you pay tax 3964. And then this is the final profit, 4190. $4 billion of final net profit they have earned in the year 2019. Does it make sense? So you go, all good? So you go by the steps. So you have the revenue, then you subtract the operating expenses, it gives you operating profit, then you minus the finance cost, it gives you profit before tax, and then you minus tax, and then it gives you the PAT, profit after tax. Okay, you are a startup, you are a small and medium enterprise, or you are a multinational companies having operations in almost every country on this planet. The principles, the structure, the layout, if not same, is similar, but the theories remain the same, you know? So the layout, the overall structure of the income statement of a company, you can talk about some small company producing pulla in somewhere in Korpilahti, but the philosophy would remain same. The ideas would remain same. They will not change. The figures would change. Little bit of accountants' discretion would change, but the philosophy will not change at all. So the final profit, which British Petroleum has, is 4,190. Now, there are a few things which I still want to discuss, but I will put on hold. Now I want that for the remaining time, for another 25 minutes, you pick up some companies. It's up to you. You can pick any of this company, and the best way to reach the financial statement is just Google KLM annual report. That's it. For example, I can do it for you. If you want, I can do for you. And it's not showing? It's not showing. Ah, it's working. Okay. So for example, if you are interested in checking KLM annual report, let's say 21, it's fine. Annual reports KLM 21. And then you can open the PDF. You can, does it show the PDF? Huh? Close the speaker. Oh yeah, so you can have the PDF. And maybe. And then you can see from the contents page, you can see in the contents, there should be financial statements. Where are the financial? Consolidated financial statements. So if you go to page 104, then you will see the KLM's income statement. But today we only discussed one statement, which is called income statement. So we will go to the income statement, no other statement. Yeah, this is the statement of profit and loss or income. I can zoom in if you want. Same way, you can find the income statement of H&M or Netflix. So you have a list here. So please try, or Total. I gave the list from different industries. KLM is airline, Total is oil, Microsoft is IT, Tesco is retail, very famous British company. GlaxoSmithKline is another British company in pharmaceutical. H&M is fashion industry. I think it's Swedish. Yeah, it's Swedish, yeah. And actually, a very interesting story. I happen to be in a city called Västerås. And Västerås is a city in Sweden where they started H&M. And actually, I went to the H&M's first store, the parent store, you know, in the city center of Västerås. Västerås is a very small city in close to Stockholm. And Netflix, we all know Netflix. Who doesn't know? Tell me. So you can just try the name of the company and the annual report, and then you will see the PDF. and go to the financial statements, but only the income statement, because today I only showed you the income statement of British Petroleum. So just focus on income statement, I repeat, nothing else.